What is inflation? To really understand inflation, you need to know what money is and why we use it. Money represents the value of hard work and producing things that other people want to use. The measurement of this production or hard work is done with units of money. For example, if I spend $20 to buy a can opener, that $20 represents an hour of work serving food at a restaurant as an example. The backbone of this idea is exchanging and trading goods, because making everything you need by yourself may not be possible. The assumption people make is that $20 today is $20 tomorrow. Actually, it is not. The prices of things are constantly changing, and the value that this $20 can purchase depends on when you use it and what you buy with it. Want proof? Look at the price of food items, gasoline, education, rent, utilities, and many household goods and services over time. In world economy, prices are going up most of the time for most items, and this $20 is buying less and less every year. To see a drastic comparison, in 1920, $20 bought you a suit, a belt, and a new pair of shoes. But, today this $20th may buy you a belt only. This is inflation. Inflation is when the prices are rising and more money is needed to purchase things. Deflation is when the same money is buying more things. This has been happening with technology, clothing, and internet shopping as some examples. Inflation is also defined as the rate at which the prices are increasing, and the rate at which the value of the dollar is falling. What can you do about it? Back in the 1970s and 1980s, you would get raises at your job each year that were at least equal to the rate of inflation. This allowed you to buy the same things for the same amount of work that you were doing. If you are an investor, you would park money in a bank account with an interest rate that was the same or higher than inflation. But this is not the case now. If you were a landlord, you would increase your rent by 5% to counteract the increase in your expenses of 5% such that your rental property would create the same amount of profit in spite of inflation. What happens if you don't get this raise, or investments are not paying a return equal to inflation? The value of the work you are doing becomes worth less. The value of the investment capital also becomes worth less over time. If this trend continues for a long period of time, your labor will not allow you to buy very much. Once the capital diminishes to the point that nothing can be purchased with it, this is called insolvency. How do you know the effect that inflation is having on your purchasing power? You need to look at how much your income or capital is increasing each year versus how much the things you need are increasing in price every year. The government puts out an average number called the Consumer Price Index, CPI, which is supposed to capture this for the average person. To know your personal impact, you need to calculate what your income and spending amounts are as they change with time, preferences and income generating ability.